When you own a home and you have a credit score that's in the 500s, that doesn't have to stop you from getting cash when you need it. That's because your home equity actually gives you a lot of options. But you need to know which one makes sense for you. Today, we're breaking down 3 of the most popular ways to tap into your home's equity when your credit isn't perfect. Option 1 is a traditional home equity loan. With this option, you get a lump sum up front and start paying it back right away, usually with a fixed interest rate and fixed monthly payments, with terms often ranging from 5 to 30 years. That means if you take out $50,000, your monthly payment will never change, although you may not qualify with a low credit score. And if you do, you'll likely pay a much higher interest rate. Option 2 is a HELOC, or a home equity line of credit. Most HELOCs start with a draw period, usually around 10 years, where you draw cash as you need it and often pay only interest on what you borrow during that 10 years. The interest rates on HELOCs are usually variable too, which means they can go up and down, but you should always plan for them to go up. And when that draw period ends, you enter the payback phase, which can last another 10 to 20 years. At that point, you can't borrow anymore, and your monthly payment jumps because you're forced to pay back the principal too. So if you borrow that $50,000 and pay the interest only, expect your monthly payment to spike when the draw period ends. That and the changing interest rate could catch you off guard if you aren't careful. Option 3 is a home equity agreement, or an HEA. An HEA isn't a loan. It basically lets you sell a cut of your home's future value for cash today. There's no interest and no monthly payments because you aren't actually borrowing money. You won't pay a dime month to month. But when you settle up down the road, whether you sell, refinance, or buy them out, the investor gets a cut of what your home is worth at the time. That means if your house rises significantly in value, that $50,000 could end up costing you $100,000 or more to pay off. So which option is right for you? At badcredit.org, we review home equity options based on what they cost and how accessible they are for people with lower credit scores. And you can see our latest ratings by visiting our site or by checking out the link in the description.